Today we look at how you may be getting duped with your life insurance, and how if you chose the wrong one, it may mean less money in retirement for a nice house, travel, or whatever your dreams are. So let's get into it. Does anyone else find it ironic that life insurance is useful when you aren't alive? Okay, why life insurance at all? It's intended to relieve some of the financial pressure that a death may bring. It can provide for anything from burial costs to paying off a home to just providing for everyday expenses for your family. Life insurance is generally split up between a couple types: whole life and term life. We'll look at each and it should give you a good feel for which one is best for you. And we'll start with whole life. Whole life insurance was developed in order to bring a couple financial products together into one: insurance and investments. Essentially, whole life is an insurance policy that you can pay into for as long as you want, even your whole life. The balance in the policy grows as you get older and acts somewhat as a savings account because it has cash value. And the insurance side is that it provides cash in the form of a death benefit to your beneficiaries if you pass away. Plus, it gives you the ability to withdraw money from your account while you're still alive if you want to. Term life insurance was developed to give you peace of mind for a term of your life. You can get all kinds of terms, but some of the most traditional are between 15 and 30-year terms. This doesn't provide any sort of investment account with the insurance. And once the policy ends, cue the jump cut, it's done. Now, when we compare the two on the surface, whole life looks like it's the way to go. Let's dig a little deeper in the well. Oh, now I got an old song stuck in my head. But let's dig deeper. First, cost. According to this table from NerdWallet, the premium cost of a $500,000 whole life policy is about 18 to 20 times more expensive than a 20-year, $500,000 term life policy. For every dollar you spend on term life, you might spend $20 on whole life. Now that's wild. Number two, investing. Whole life may cost you 20 times more, but it does have an investment account attached. The problem is it takes a long time to gain any sort of cash value within the policy because there are so many fees to start. Basically, the first few years of premiums are taken by the insurance company as profits. None of it goes to the cash value part of the policy. Eventually, it does build a bit, but according to Policy Genius, a company that's dedicated to all things insurance, the whole life really isn't that impressive. It says most people don't need a cash value life insurance policy, which is costly and complex to manage. Cash value accounts usually come with a limited investment options and relatively low rates of return, like dismally low rates of return. Whole life will generally grow at a 1.5% rate of return according to Consumer Reports. Now, that number has maybe gone up since the Fed's been raising rates so much, but even before the Fed started raising rates, that was pretty low. So you've got the whole life with the investment account, and then on the other hand, you have term life insurance, which doesn't have any sort of investment component to it. When the policy runs out, it runs out. Number three, death benefits. When it comes to the benefits of life insurance, term life provides exactly what the amount was when it was purchased. So a $1 million policy would provide $1 million in the event of a death. Whole life has the death benefit as well, but it also has the investment cash value part. When you're alive, you can withdraw from the cash value part of your account. The catch is, when you pass, your beneficiaries only get the death benefit. So the cash value essentially vanishes despite the massive premiums that you paid into it. According to Forbes, typically beneficiaries do not receive the death benefit plus cash value. So which insurance is better for you? So think about it this way. Dave Ramsey, one of the leading voices in personal finance, says this: when it comes to your money, never combine insurance and your investments. Let's go back to the NerdWallet table. If you put $19 per month into a $500,000 20-year term life insurance policy at 30 years old, you won't get any savings benefit from it, but your family will be covered in case something happens to you. And you'll be covered until you're 50 years old. Now, if you get a $500,000 20-year whole life policy at 30 years old, it would cost you $359 per month. No end to the policy, and you would retain some of the premiums as cash value. The longer you pay your premiums, the more cash value it has. But you can't just pull out money like it's a savings account. No, it's got to be more complicated than that. You can do one of three things. One, you can take a loan from your policy, in which case you owe it back with interest. Two, you can withdraw from your policy, in which case the death benefit will be reduced by the amount that you withdrew. Three, you can surrender the policy, in which case there's a fee for 10 to 20%, possibly even up to 40% of the cash value. But what if you took the cost difference between the whole life policy and the term life policy and just invested it into the stock market? Let's say for 20 years, you took the difference between those two policies of $340 and invested it at a conservative 6% rate. At the end of that 20 years, you would have $157,000 in your investment account, compared to less than $100,000 in the cash value part of a whole life policy. And your investments would go to your beneficiaries beneficiaries after your death, whereas with the whole life policy, your beneficiaries would only get the death benefit, none of the cash value. Now, if you're finding any value in this video, do me a favor and hit the like button, because I'm really sacrificing here with all the research that I had to do, because now I'm just getting tons of ads for life insurance. Did you hit it? Okay, good. We'll move on. Now, you may be thinking, yeah, whole life policy is much more expensive than term life, but at least it provides guaranteed insurance to the end of your life. And this is true, unless you have a different financial strategy. The way Ramsey's solution recommends is to get a term life insurance policy that's 10 to 12 times your annual income. So let's say you have an $80,000 annual income. Well, a $1 million term life insurance policy would be just over 12 times your annual income. If something happened to you, your beneficiaries could take that $1 million and invest it into the stock market. Then, provided an 8% return, they could still live on $80,000 per year just from the returns of that investment without having to pull out any of the original $1 million. Ramsey Solutions recommends it this way because if you're on the baby steps, by the time your term policy runs out, you'll be financially independent, and your loved ones can take care of themselves just from the money that you invested up to that point. But if you die within the term life policy timeline, it'll still provide for your beneficiaries' needs once you're gone. So the question is, why does it seem like whole life is frequently recommended by insurance agents? Maybe it's because there's a higher commission with the higher premium. I'm sure it's not the only reason, but it's gotta be a big factor. Regardless of which product you get, life insurance is a great idea to protect your spouse and kids. But if you want the most for your money, then don't combine your insurance and investments. Because especially nowadays with inflation, who's got the extra money to put towards a whole life policy? Just get a term policy that fits your needs and then put the extra money into a good investment, like a Roth 401k or a Roth IRA. Now, if you need to talk to an insurance agent that you can trust so you can figure out what insurance and how much insurance is best for you, or even if you need life insurance, because not everyone needs it, then check out the link in the description down below. Next, watch this video so you can learn the best way to start investing.